Hello everybody, I'm Chuck Gibson. This is Taking Stock with Art Jarvis, a bi-weekly discussion on the local, national, and global economy, how it impacts your personal financial health and wealth. And sitting right here with me in Studio A at the Loveland Beacon is, in fact, Art Jarvis. How are you this afternoon?
Chuck, I'm doing fantastic. Thanks for asking.
That's good to hear.
Doing all right?
So far.
They're good.
You know, recovering from weekend projects.
Yes.
We'll leave it at that.
Man, you picked the right weather to do it.
Well, I enjoyed the social media posts from the Jarvis/Gepford family that included Artie J's first Reds game.
First Reds game, and Artie J is 1-0.
Perfect.
The Reds beat Atlanta, thank goodness, because I think Atlanta won the other two games.
I was going to say salvaged one from the 3 games set down at the Great American Ballpark.
Yeah, it was a good game. If I'm not mistaken, the very first pitch the Reds threw was a home run.
Well, you know,
so I was like, oh, this is going to be a long day. It ended up being a good game.
So they did that more than once this year. First pitch, home run kind of stuff. But anyway, so it was a good weekend for the Jarvis/Gepford family, and Artie J at a couple of months old has been to his first major league ballpark. 29 to go.
That's right. Exactly. That's right. No, it was a good time. Enjoyed it, and of course, he being a whole 2 months or so old, he took great interest in the baseball game.
Chuck leans his head to the right on his shoulder, closes his eyes, and says, "Is this what it looked like?"
There are probably people sitting around that's like, "Why do they got that little baby sitting here?" But
so to get that first game certificate,
he did get his certificate. That is correct. So you can check that box off. So yeah, we're good. So,
well, that's good. It sounds like it was a good weekend for you. And
thank you.
You know, while it was a project and it was, tedious.
Mm-hmm.
It's moving along, so that's good. That's a good weekend too. Making progress on the project.
Yeah, good for you.
Home enhancement project.
I like to say, I can watch people work all day. So
that's what I should have been doing. Because it's a funny thing. There's companies out there, service companies of all kinds that will do the work that you somehow find like do it yourself. Mm-hmm. And then that's enough of that. But
right.
You start talking about how stupid Chuck is, and we don't want to go down that.
Yeah.
It's good. Progress is being made. Things are good.
Yeah.
And here we are in Studio A, a little bit afternoon, on Tuesday, the 2nd day of June. And we were looking back at history before we get started into the present day, taking stock. And it appears that we are into our 3rd year officially, because that first taking stock was in May 3 years ago. Thank you, Art, for the research on that, indicating that the 2nd episode was on May 30th. Is that
May 31st of 2023.
Right.
So actually, we finished our 3rd year. We're sashaying into our 4th.
We've completed 3 years. We're now a couple of weeks into our 4th season.
Yeah. So let me give you a little tidbit of what those 3 years have looked like.
Okay.
So, because I'm sitting there entertaining myself at home, and I start looking at history and stats and stuff like that, and we spent the vast majority of our first 3 years talking about recession, which never occurred, right?
Hallelujah.
Hallelujah. We've talked about how the Fed wants to get down to a 2% inflation rate. Hasn't happened, and we made the comment that it's getting back from 9 or 10 in 2022, getting back down to 3 or 4. That's one thing. To go from 3 or 4 and try and get down to 2, that's a whole other ball.
Well, and those who are listening now, and who have listened in the past, and myself who have listened to you through these 3+ years now, know that you're perfectly happy with a 3. It doesn't have to get down to a 2.
Yeah, but you're exactly right. I mean, don't get me wrong. I'll take a 2, but I mean 3 works. Because when you talk about people retiring and where you think things are going to be in the future, generally speaking, the value of your house, generally speaking, just use like a 3% inflation rate. Okay, so what's the risk if I'm looking 20, 40 years from now, and we're saying, okay, your portfolio has the potential to be between here and here, but what's the real rate, right? Because now don't forget, you also have 20 to 40 years of inflation too. So, $1 million becomes $2 million, but guess what? That $2 million isn't worth what that one, what it was worth 20 years earlier or whatever. So I use the 3%. I'm happy with that. And
So recession and inflation, as you reflect upon these past 3 years of taking stock.
Yeah, and how generally speaking, poor things were going to be, and how our economy was not going to do well, and and how it's interesting to me how wrong the predictors have been. You talked about sliding into a shallow recession, or the year-over-year gross domestic product being less than 1%, and then the next thing you know, it's 3% or 4%, and right now running 2 point something. So, but here's the big thing: you look back at the portfolios, and let's just say it's a 100% stock portfolio. If you look at the last 3 years' average annual return, it's almost 20% per year. It's like 19 point something percent per year, the portfolios, okay? Now, if you were 100% in the NASDAQ or 100% in technology, you'd be way, way past 20% per year. But just looking at a diversified portfolio, and we've talked in the past that I do believe that in general, the stock market over the long term gives you basically about 10% per year. Now, it's very few years where it actually does 10, because you've got great years, you've got terrible years, but you end up averaging. The last 3 years, we've been averaging almost 20%. It's a big number, okay? And then especially this year, this year we were down 7.5%, 8% in the first quarter. And now we're probably up 12 or 13% now on the S&P 500. So we've had had over a 20% swing. Again, we did the same thing last year, if you remember. Because of the tariffs. Now this year is Iran and oil and interest rates, right? So here we go again. We've had this great big swing, but as we sit here and talk, and don't let me get ahead of it here, but made a prediction. If we made a prediction, but the magic.
We're going to say that never happened.
Okay, but the magic number in my head was somewhere.
When January 2026 came around.
Yep.
We had the first Taking Stock episode of the 2026 calendar year. And you and I talked about, we didn't prepare and say, hey, let's plan to do our prediction show. Let's plan for you to put your forecast out there. So we talked about it a little bit, but we never officially put out Art Jarvis and Jarvis Global's forecast for 2026. So we can't.
You're right.
So.
But in fairness, the number I was tossing around was like a 7,600 number on the S&P 500. Okay. Now, interesting, I don't say a number expected to be that's the number we finished at exactly at the end of the year, right? I mean, there's a certain probability that it would be, based on interest rates and based on earnings and things like that, and based on what's normal, you might be less than 7,600. There's a higher probability that you kind of hit and everything's kind of normal, and if we have these interest rates and we have these earnings, we'll probably be around that $7,600 number. And then if things go really well, you could say, and psychology starts driving the market, but for a much lower percentage probability, maybe we're in that 78, 7,900, 8,000 number, but that's the lower probability. So typically I kind of go for the middle of the range and say, it should be somewhere around here, conservative like. So just say it was 7,600. So here we are, the second day of June.
No, wait a minute.
Okay.
Transition mode. So we have completed I'm sitting at home and I'm looking back over the 3 years that were dominated by the big R word.
Yep.
And the I word, inflation. And so now we're done with that reminiscence. Now we're sitting modern day, Studio A, Loveland Beacon, And we're talking today, June the 2nd, 2026. So what do you got for us?
We are above 7,600 on the S&P 500. So
how did I know we were going there?
yeah, so we're at 7,611 this morning.
Woo.
Or this afternoon. We closed yesterday at 7599.96. So we were 4/100ths of a point away from 7,600 at the close yesterday.
And we've opened the day in an upward trend.
Yeah, I mean, so far so
with
good.
The S&P 500.
But we have come a long way in a very short period of time. And here's it, I mentioned to you this before we started recording is, Friday, we've had some great days. I mean, the market in many ways kind of looks like a rocket taking off, okay? But we've had some great days. Friday was no exception. Friday, once again, I think it was the S&P 500 and the NASDAQ and the Dow Jones and the Russell 2000, all indices, they all hit new highs on Friday. So let's look at the S&P 500. So there's 500 stocks.
Hopeful news on this past Friday.
Yeah, I mean, don't get me wrong.
Impacting the market. Right,
yeah.
Go ahead. Yeah.
I'll take new highs, don't get me wrong.
Right.
But the interesting thing is that there's 500 stocks in the S&P 500.
Yes.
How many stocks do you think actually hit new highs out of those 500 stocks?
Well, there's 500 stocks in the S&P 500, which is thus the name, S&P 500. Which, and for people who don't know, Standard & Poor's, right?
Correct.
Just
yeah,
to be
correct.
sure. So Standard & Poor's 500 top companies. So they're stocks. There's 500 companies. And you're asking Chuck Gibson,
That's right.
how many of those 500 hit
Yep.
new highs?
Yep.
And Chuck's honest answer, unknowing, is I have no idea.
Okay.
But the only thing I would say is probably not all 500.
No, definitely.
But anyway, so what's the answer?
The answer is 20 stocks
Out of 500.
out of 500. And you want to take another wild guess? The general area that those 20 stocks were from?
Well, see, now that Chuck Gibson has learned in these 3+ years of taking stock with Art Jarvis, I have learned, and I know what's happening, to date. Right now, we've been talking about it. So the tech stocks is what I'm going to say.
100%. And even more specific.
100% of the 20.
I'm not going to say 100% of them were, but it was.
But 100%, that's the right answer.
That's 100%. That's the right answer.
The majority is tech stock.
Yeah, that's the vast majority, and so that is not
from
indicative.
the DJ Industrials and the Nasdaq.
Everything, whatever. That's what drove it, and that is not in any way, shape, or form indicative of a broad-based up move in the market. And here's the other thing: you say technology, but here we are. Let's say last year the market's going through the roof. We're up 20-something% or whatever, and it was basically Nvidia and a few other stocks that drove the market up, right? And the nice thing kind of toward the end of the last year is we started to see some of the laggers start to catch up a little bit, which was nice. But here we are again in 2026. The markets are hitting new highs, but there's not a whole lot of stock. I mean, the stocks are going up, don't get me wrong, but they're not hitting new highs. There's only 20 stocks that hit a new high on Friday. That's not a broad-based move. And it's something you have to keep an eye on. You look at some of those 20 stocks, they literally look like rockets taking off. There's securities out there that are up 100% already this year. And they really, it's parabolic. There's graphs bouncing around, and all of a sudden it just looks like a rocket took off from Cape Canaveral or something like that. We need to take a breather, in my opinion. And there's a whole lot of news. If you look at the financial news and things like that, there's a whole lot of comparisons going on between what's going on in today's market and what was going on in 1998 and 2000, right before we hit the dot-com bubble. Okay?
Right.
So I in no way, shape, or form am I about to say we're about to have a bubble burst. But because there are differences between those two things. But there's a lot of people talking about how these two things look very much and feel very much alike each other. So, I think it's worth looking at. Let's be clear about that.
Well, and that's what you said a moment ago. Is like it's worth watching. 20% is not a broad-based move. It's worth watching. So what's the? And I'm not going to use the word advice, but what's the warning that you put out when you say it's worth looking at. It's worth watching. What does that mean to the investor that hears this episode of Taking Stock?
Well, here I'll tell you what's going on in my world right now. Okay. So I'll use the technology sector as the best example. When we first put maybe a tech stock or tech sector into a client's portfolio, generally speaking, we're putting about a 5 to 6% position into the portfolio. So, let's say we put technology in a client's portfolio 3 or 4 years ago. About 6% of the portfolio. Well, we have begun just taking some profits in the tech sector because of the way it's been acting here recently and things like that. But the problem is it's now a 13% position in the portfolio, a 14% position. That's how much the tech sector has grown and risen, number one, but that's also how much it has risen, how much faster it's risen than the portfolio as a whole, right? So, I mean, it's not like tech's gone up 100% and industrials have gone up 100%. Tech's gone up 100% and industrials gone up 25%. It's something along those lines. So, to answer your question, first thing is just to want to take some profits. I don't want to have a sector in the portfolio that's just completely taking over the portfolio. Okay,
right.
So if something bad were to happen, it's going to have a bad effect on the portfolio. I want something a little more diversified, a little more well balanced. So there's that going on. But again, it's worth keeping an eye on. It's also worth going in and trying to find those sectors. And again, we're what I call growth at the right price.
Right.
Firm. So I want to buy companies that have good growth rates, but I want to pay a reasonable price for them.
Yeah.
So if you can go out there and find sectors or securities that have good growth rates but have been neglected over that same time period, that's a good opportunity to take some profits from this part and then move it over and move it into a different sector or a different market.
Well, that's a good spot for me to jump in and remind, and for you and I both, to remind listeners who have heard this before, and maybe for somebody who's listening right now to this episode and hearing it for the first time, take some profits. And that doesn't mean like call your guy, call Art if he is your guy, and say, hey, give me some of that money. Okay. It's take some profits out of that sector. Right now, you're seeing this, and it's worth watching, is what's happening in the technology sector, and it's all of a sudden, what was a 6% portion has become this 13% portion. And when you say take some profits, it's like move that. Yeah. It's not, cash out. Yeah. It's move it. And as you just, and the great word that we should always keep in mind in the investment world, at least I believe, and I'm pretty sure you do, diversified. Yeah. Yeah. And so take some profits from a sector that's growing at a watch rate, well, I'll call it, and move those into a little bit more diversified area. Mm-hmm. Yeah. And hopefully, and then your strategy that you said for the firm Jarvis Global is, how did you
growth at the right price.
Growth at the right price.
Yeah, GARP.
And so by growth, there you go.
GARP. GARP.
We won't go into GARP. you know the GARP story, I'm sure. Gotcha. The world according to GARP, right?
Yeah, of course.
I said we're not going to go there, and I went there anyway, but sorry about that. But yeah, growth at the right price, in a diversified manner, is a good, sensible way to take some profits from an area that, as you said, you don't want it to, overwhelm the rest of your portfolio and suddenly become, and then you hit that danger zone. Because what if we are on the verge of a bubble burst? Right. But if you're diversified, the bubble bursts, and you get hurt a little bit here, but you're still okay, right?
Yeah, you're not hurt as much.
That's the theory.
Let's put it that way. Yeah, I mean, you're not hurt as much. And I want to be clear about one thing. When I'm talking about taking profits, I'm talking about giving a position a haircut. I'm not talking about all of it gone, right?
I'm not shaving it.
Yeah, we're not doing high and tight. We're just giving it a haircut, right? We're trimming things up. We're making it look more reasonable. So, but I mean, a good example is, let's say we put $100 into the tech sector, and 3 or 4 years later it's worth $200. Okay, if we take that 13% position back down to a 6 or 7% position, basically we just took your money off the table, moved it into a different place, and now we're playing with the house money.
Right.
Okay.
Back to the 100 startup.
Yeah. So
back to the chips you bought when you walked in the door.
Yeah. Right. Hopefully. Yeah. So that's it's the whole right pocket, left pocket thing. Play the right pocket and take the winnings and put it in your left pocket, and when the right pocket's done, move on. But it's
or something like that.
Yeah. No. I mean,
well, because I always
one
played
strategy.
left with the winnings in my right, but that's it.
So your point is very well taken, and it's correct. I just wanted to make sure people aren't, I'm not saying dump an entire sector right now, but, if you go back to a 98 and 99, and I'm kind of treading lightly on this discussion because I don't want people to think really bad things are about to happen, okay? But,
hey, listen, just for clarity there, I can tell you sitting here in Studio A with you recording this, that's not what you said. You said people are seeing the signs of similar activity before that bubble in 98, which was the .com bubble that came after that.
And that was a process. I mean, in whatever number of months, the problem was I had people come into my office, maybe a prospect or something like that, and I'm trying to sell 8 to 10% returns to them, hopefully over the long term, and they're like, well, the last 3 years I've made 50, 60, and 70%, right? Yeah. And I'm like, well, where's your 8% assumption? Where's your 9% assumption? And they're coming to me with 40% of your assumptions, and they're literally a quote is, I don't need you for 8% returns, and I was like, oh, okay, and guess what? 2000 rolled around and it got ugly fast, and the NASDAQ 100, it dropped 80%. That's how far ahead the .com stocks were ahead of where they should have been.
Well, what are the things? Go ahead and finish that.
Well, but the point was it's kind of a process, and the problem the process is you kind of get more. Now let's say things do get really. What I was going to say is the reason this kind of feels like back in 98, 99. Kind of went through the same process that tech sector, again, it was tech and .com stocks, just going through the roof, parabolic graphs and things like that, and it did the same thing, took profits, but guess what? You're taking profits out of a sector that continued to outperform for another year. Okay, so guess what? That caused our portfolios to underperform a little bit for a year or so. Nothing drastic, but we did underperform in like 1999. But guess what? 2000 hit, and all of a sudden you're looking like I'm not going to use the word genius, but you're looking pretty good compared to the rest of the market, right? So you made some decisions, and and you end up getting all kinds of new clients because these people got totally burned. Because their portfolios had almost become 100% tech portfolios, and that's what you're trying to avoid. Okay, if it's too good, if it feels like or it sounds like it's too good to be true, guess what? It's too good to be true. Now I can't tell you if we're not going to go for another year or so. And the difference, you're looking at the .com stocks from 98, 99. A lot of these were trading on earnings that weren't even close to where they were being valued. The difference with like the AI stocks and things like that now is they actually have earnings. They actually have profits. So you could easily make a case that this could go on for another year or two. Okay, but it's got to stay reasonable. And again, from my standpoint, and I'm never going to change. I'm going to continue to be a growth at the right price.
Too long in the tooth for change now.
Yeah, I'm a grumpy old man, so I'm not going to change. Because number one, guess what? Out of 40 years, the vast majority of the years, it's worked pretty well. Okay, I haven't been a winner every year in 40 years, but it's been close enough. And then there's been some good years, and when things get out of whack, guess what? It's kind of the old Warren Buffett thing. Back in 1998, 1999, everybody was saying Warren Buffett was outdated. He doesn't know what he's talking about anymore. Blah blah blah. But guess what? Old Warren Buffett ended up being very, very right about what he was doing. But yeah, you stick to what you know, number one. But number two, if you continue to take profits in sectors that are outperforming or doing way better than they should be doing or you think they should be doing, and move to sectors that have been neglected, that are solid companies and have solid earnings, and you're paying a reasonable price for them, in the long run, you'll be in very, very good shape.
Yeah. So. Well, you sort of touched on, I almost interrupted you with a question that would have taken us off of your point. I didn't want to do that. But the question was, and I think you've touched on the answer a little bit, is so what are the lessons learned from the dot-com bubble burst from, the 98, 99, ultimately 2000 burst? What are those lessons learned that have created a situation in the investment world to protect against that? And I think you touched on some of that, is just, hey, learn the lesson and maybe underperform for a year, but knowing that you have diversified to like a safe place.
Right.
I don't know if that's it.
Well, I mean, look, and again, it can be somewhat of a tough conversation depending on, I have the benefit of having clients for 30 years, right? We kind of know each other pretty well, but I also have brand new clients that I've had for a week, right? So, but let's say the market goes up 20% and we only go up 15 or 12.
I'm calling you.
Yeah, well, I mean, there are clients who will call it. The market was up 20%. Why am I only up 15? Why am I only up 12? And I'm going to tell them, because it's all technology. It's this, and we're running a diversified portfolio, and but guess what? In the long run, you end up, and again, our goal is to outperform the market by doing the market on the upside, do a little bit more than the market on the upside, and then to try and do when the market's going down, to try to do 25 to 50% of what the market does on the downside. So where we excel, I believe, historically have excelled, and can't guarantee the future, but we have ended up substantially outperforming the markets with less volatility because we've limited the downside during the downside years. So again, if we continue to do that, we'll be in good shape.
Numbers.
Well, guess what? I mean, it is what it is,
well,
right?
and again, it's just reaffirming your position of like, I watch the numbers because the numbers tell the story. That's what Art Jarvis has told us in the 3+ years now.
Yeah.
That it's, that the Jarvis Global firm is watching the numbers and paying attention to what the story that those numbers tell, and then invest in your money, whoever you are. Yeah. I could say our money now. We don't want to tell the audience that, but nonetheless, I could say that. Anyway, so the bottom line is this discussion all started with well, first we had the nice reminiscence. That was very nice.
Yeah, very nice.
That was very nice. I guess it's sometimes good to look back and say, what was the discussion? What were the concerns? What was that, that one word, what was the uncertainty that we went through in these first 3 years of, taking stock? And then being able to look back and say, hey, guess what? And what lessons do we learn from talking about those inflation numbers and what was the other?
Putting earnings numbers, inflation numbers, interest rates. Oh, you mean recession?
Yeah, what was that other thing?
Yeah,
that never happened.
Yeah, well,
inflation just continues.
True.
And you saw, because for the listeners, Art tries to send me some information during the week or the 2 weeks between shows, and this past week was an unusual amount of good images, good graphs, saying what's been going on. And one of those was telling the story of the trend of inflation. And you remember what my response was, right?
It's never going away, or something along those lines.
Well, that's the gist of it. Well, now what we got to do is get it to go back to pre-inflation prices, which, here's a great question for you and I to have some fun with right now. What was before there was inflation? What was the prices?
Well, I don't know. There's always a crisis. Right. Let's be clear about that.
Because inflation.
Before inflation was COVID.
No, I mean, no, inflation's been going on like, there is what was the date? Was it 1935? Was it in the 2000? When did inflation start? I mean, when I say we're not ever going to get back to the pre-inflation prices, what was inflation?
There's always been inflation.
Price increases happen.
Yeah.
But like I said, that's just a question for us to have some fun with.
There's been very few periods in time where prices have backed up, right?
The other fun thing on that whole topic of getting the prices back is the thing that causes the greatest consternation, at least here, to us here in America. It seems, and I don't know about the rest of the globe, but I've been a few places, but not everywhere. So I don't know. Gas prices, the price we pay at the pump. Yeah. Interestingly enough, they go back. I mean, we're not getting back to 29 cents a gallon, which for some of you listeners, you never saw those days. Yeah. But I am old enough to have seen 29 cents a gallon. In fact, when I first got my driver's license, below 50 cents a gallon gas prices. Yeah. So, but the point is, as gas prices have risen, and it's, like I said, it causes great consternation for the American public. It seems like the American driving public, we can't stand it, and we're going crazy. But it's the one thing where prices go back. Mm-hmm. They go back to if gas inflation stuck and never went back, how much would we be paying a gallon? Because we've seen it go, especially across the country. I mean, I don't remember what year it was. Probably 2003, 4, 5 or something. And gas prices were over $5 a gallon in California. I was out in California.
A barrel of oil went from what, $20 a barrel to $120.
Right.
Yeah.
So anyway, that's an interesting side note where we talk about it, and the thing that gives us the greatest consternation is the price at the pump. And yet the price at the pump is the one thing that seems to go back, roll itself back, and we're in the middle of a bit of a rollback right now. Hopefully because of things maybe settling in Iran.
And that's the problem. That's the problem right there. I mean, using gas as the example, gas has been artificially influenced by outside factors. Okay, so it's going to a place where it shouldn't be in the first place.
Right.
Okay.
Right.
So when the things that are causing the problem, whether it's the price of oil or it's the uncertainty of what's going on, in Iran and things like that, that once you start taking some of that uncertainty out and things like that, that's when you start to see it come back. But it was the same. Look at eggs. Let's take eggs as an
We've had a lot of fun with eggs.
Egg prices went through the roof back in 2022, 23, right, somewhere in that area, 24 maybe even. But guess what? Eventually, they
actually 24.
Yeah, they worked their way back
to
something. Maybe not to where they were to begin with, but back to, they weren't twice the amount for a dozen eggs or whatever. So that's outside factors. But there is, I'm going to use the word systematic inflation, okay? It's just, the definition of inflation is too many dollars chasing too few goods, right?
Right.
So if things are going really well and you're starting to see great payroll increases and things like that in the markets, and you're seeing people's 401ks go up and their investments go up and their housing values go up, not only does that maybe give them a little more discretionary income, okay, it also gives them a little more confidence in what's going on in their lives, so they're more apt to go out there and spend. Well, if you have an entire group of people who are out there spending more money because they're feeling better about themselves or about the markets or things like that, that right there will make prices go up just because the demand has gone up and maybe the supply hasn't moved with it. So, I mean, you're making a good point, and gas is just aggravating. That's all there is to it.
That's why consternation's the word.
But we've been going on for how many months now? 3 months with
Without
with
any-
gas prices
Wow.
in the fours at least, sometimes in the fives, maybe in the high threes. There again, we've talked about this in the past. There's a subset, there's a group of people out there. When gas went from $2.75 a gallon to $5.25 a gallon, that has a huge impact
Right.
on their lives, right? So that's something that so that's why I can't honestly I can't believe here we are 3 months later and this is still going on, to be honest with you.
Yeah.
But I mean, it's one thing if you get hit a couple of times at the pump. It's another thing if you get hit at the pump for 3 months in a row. So
Well, let's plan to talk about it a little bit because there's some more information about what happens and what drives the price of the barrel, the barrel of oil, and how that may be changing. So that's going to be the tease for 2 weeks from now. We'll talk about that because I gained a little bit of insight, and so. You have insight, so we'll talk about that in 2 weeks.
well, hopefully
But
there's
guess
big
what?
changes between now and then.
But guess what? This week of Taking Stock, episode number 74, has come to a close.
Time flies and you're having fun.
I'm pretty sure we passed the 30-minute mark.
I'm pretty sure we
But
did.
anyway, we're at about 35. But Art Jarvis, thank you so much again for your time today, especially the bonus 5 minutes to take us to 35.
No charge.
Oh, thank you. Okay. Well, it's sponsored by Jarvis Global. Jarvis Global Investments, LLC. So thank you to Jarvis Global Investments for paying for the extra 5 minutes that were free.
Nice.
But no, all kidding aside, again, thank you so much for sharing your insights. The conversation moved fast today. The minutes
It's interesting
flew by.
times right now, so we're going to have some more interesting conversations, I think. So, looking forward to it.
Well, that's it for today.
All right. Thanks, Chuck.
And listeners, thank you for listening in. Come back again in 2 weeks for episode number 75. For now, I'm Chuck Gibson, and this has been Taking Stock.